Welcome back to the Investing on the Go podcast, brought to you by Fund Caliber. This week we dive into the global mining sector, exploring the major trends shaping the future of commodities, from energy transition to shifting geopolitics.
I'm Chris Sarley, and today we're joined by Evie Hambro and Olivia Markham, who co-manage the elite-rated BlackRock World Mining Trust. Evie and Olivia, thank you very much for joining us today.
Thanks so much, Chris. Lovely to be back again.
Good to see you, Chris.
Thank you. Let's start with the big question across the board. It's almost 2 weeks since Liberation Day. Everything is changing every day. So we are recording this on the 16th of April. I guess the open-ended question really is your thoughts on it, and has it had any material impact on the construction of the portfolio in this new sort of climate?
Yeah, I mean, I think I'll say a couple of comments on this one. So, I think the first thing to say with regards to what's going on in Washington is that it's anybody who tells you what's going to happen. I wouldn't necessarily believe them because I don't think anybody knows at all. So we're dealing with a news flow that is having impacts on markets, creating higher levels of volatility, and it seems to be a couple of steps forward, a couple of steps back, and sometimes one step forward and 3 steps back, and 3 steps forward and 1 step back, and so on. So I think trying to kind of adjust the portfolio to take advantage of that in the short term would be unwise, because I don't think there's any information advantage or insights that you can have. I think a more general thing is, obviously this is creating disturbance to trading in terms of economic trading. So if you were going to be buying cars now with tariffs attached, then they're going to cost more. If you want to buy materials and there's a tariff, you're probably going to try and buy it from a country where you don't have to pay the tariff. So trade routes will be moved around. But the overall net impact is this is disruptive to economic activity. It puts friction into the system, which is an additional cost. And the question is, how much of that flows out as in terms of an impact on inflation? And what does that therefore mean for interest rates and equity risk premiums and so on? And then the kind of the other element that comes from this is, what does this do to geopolitics? If you're aggressively focused on tariffs towards China, does China then lean into try to be closer to Europe, etc.? So how long these things take to kind of settle down, the scale that they finally end up at, and the tensions that they create will all be important. But when it comes back to our portfolio, we've been carrying a bit less risk, which is a sensible thing to do given the uncertainty around tariffs. We've had a higher weighting towards gold, and we've had that for quite a long time now, not just a few weeks, a year or two. And so that's been a positive for the portfolio. So we hope we've navigated it as well as we can.
Okay. I want to talk about one of the things you mentioned recently, which was that you felt one of the biggest challenges you'd seen in the past year was sort of the breakdown in the relationship between commodity prices and the share price of the companies that have produced them. Could you just explain that to the listeners? And then perhaps, is that the case across everything, or is it certain areas of the commodity market?
Yeah, Chris, I mean, we definitely saw last year, particularly as we moved into the last quarter, that there really was a disconnect between the commodity prices and the share prices of the companies exposed to those commodities. I think this is probably most notable in gold. So if you have a look last year, the gold price performed very strongly, but a number of the gold equities actually finished the year down. And that disconnect, part of it can be explained by things such as, higher cost, not as much cash flow generation. But we really saw it as an opportunity, and we used that opportunity, which has turned out to be quite, fortuitous this year, by actually adding back to some of those gold equities because of the disconnect and how they would normally trade with that underlying commodity price. We saw some similar things happen in copper too, actually. As we moved to that back end of the year, some of the copper equities, really started to perform a bit poorly relative to the copper price. And I think this kind of, to me, part of this has gone back to concerns around noise of tariffs and what that could do to global growth. So I think as we're navigating through this period, we are seeing disconnects between equities and a bit of equity derating relative to the underlying commodity prices. But over time, these do recorrect again. And so we're selectively looking at opportunities there.
Okay. I mean, you mentioned gold and copper there. I mean, they're the two I want to touch on in the next couple of questions. Gold and gold equities, obviously, they accounted for about a quarter of the portfolio at the end of the last annual report. I'm guessing that might have changed now. There obviously is that disconnect. Do you look for any specific catalyst that might re-rate the equities in the past 12 months? Or is there anything specific, or do you just look purely at the price and go, this is too attractive to turn down at this current level?
Yeah, it's a good question. I think the journey on this has been quite interesting. As Olivia just said, sometimes you do get these periods of time where the underlying performance of the commodity completely disconnects to the performance of the company producing that commodity, and you see it in the oil space and so on and so forth. And it's a function of interest rates, equity risk premium, etc., that drive that. I think when it comes to the gold space, we have seen significant divergence. So we've seen a very, very strong gold price, which has continually moved to high levels. And the first part of that journey, the gold companies were not converting those higher prices into higher margins. Yeah, and as a result, the gold companies were significantly underperforming the price of gold at that point in time, and through to that point in time, we had an underweight position towards the gold equity space because we were positive on the outlook for gold, but gold shares just were not delivering. As time went on, the gold price got to a level where it kind of broke through to above a point where most gold companies should be able to capture that. So it had risen faster than the inflationary impacts and so on, and therefore the margin conversion or margin capture was going to be higher. In anticipation of that happening, given our positive view on gold, we started to build our gold equity exposure up and moved to a significantly overweight position in gold equities. And principally through gold royalty names, and then through more broader exposure into the gold producers, and that position has continued. And as you said, we are a lot higher today than the 25% number than you talked about. Part of that is the move in gold equities versus the rest of the mining universe, and part of it is deliberate in terms of how we have positioned ourselves. I think the other thing to do is we've also seen not just what I mentioned in terms of the cost conversion, but we've seen this divergence between individual names. And so, a company like Agnico Eagle, which is a big position for us, has done incredibly well. They've been the kind of leader out of the larger gold producers. They've had this fantastic track record around being able to deliver. And you compare that to some of the other large producers who have materially underperformed that company. And that's because they haven't delivered operationally. They haven't converted those higher margins from the rising price. They've had operational challenges, et cetera, and that has led to underperformance. So, although you could have been right to be in gold, if you've been in a gold equity ETF, which has huge weightings towards these large caps, you would have underperformed because of that. So many of them haven't been able to deliver what you had hoped they would be able to deliver. I think the phase that we're going into now, though, is that with gold prices where they are right now, and you mentioned when we're recording this, gold's at a new high, through $3,300 an ounce. Gold companies should be printing cash at these numbers, and we would hope this starts to come back to shareholders in terms of dividends. And it's been really interesting to see a large number of gold equity companies announce share buybacks as well. So there's a lot of focus on shareholder returns here.
Just quickly on that, just a quick point on that. You mentioned those buybacks. You also mentioned they should be printing money. If we don't see enough of that, do we think M&A will pick up in that area again?
Yeah, I mean, M&A is a constant in the sector. I'm showing my age here, but I started doing this job over 30 years ago. The sector was much more fragmented than it is today. We've seen huge amounts of consolidation. So a big gold company, 30 years ago might have been doing 500,000 ounces of gold a year. A big company today is doing 5 million ounces of gold a year, and that's because they bought other businesses and so on. So there's been massive consolidation. Is there room for more? Always, there's always room for more. But I think it's going to be much more targeted and focused when it happens. So gold companies looking for specific assets they might want to build into a portfolio or specific exploration projects, etc. I think rather than just general consolidation, big for being bigger kind of thing.
Okay. I want to turn to the base metal side. And again, you have around 30% in copper. The story on copper is it sort of reached record highs last year, and that was supported by China's focus on green spending. And if I'm right, it was sort of at record highs until sort of last month. And the story's been that, again, it's suffered with what's happened with Trump. And then I think only a couple of days ago, there's been a bit of renewed hope that there might be some exemptions, etc. Do you almost put the short-term story in a bucket on the side and go, electrification, AI, all these things need copper. There's only so much copper in the world, just focus on that long-term story when it comes to something like copper?
Mm-hmm. I mean, copper has been an absolutely fascinating market. The last couple of years, I think, as the world has become increasingly focused on electrification, they've recognised that copper is almost like a linchpin in that equation because we do need to see a significant amount of supply growth, and that's a real challenge for the industry. So I think the long-term fundamentals of the copper market look very healthy. You'll hear lots of companies talking about copper deficits in time, the need for higher copper prices, and I would support a lot of those positive comments out there. But you're absolutely right. In the short term, copper is kind of like the bellwether commodity for global demand. And as you go through an environment of trade wars, it becomes, just from a macro, shorter term perspective, challenging for the copper price. It's been really interesting, though, when you actually have a look before we kind of had the tariffs being announced, actually just how well the copper price performed. Actually, at one point in time, the copper price was up more than the gold price year to date. And then if you look at the COMEX, or the US copper price, up even higher. That very quickly unwound on the back of tariffs. But actually, when we kind of look into the physical market, it still looks pretty healthy. Like, you go to China, premiums to bring copper into the country are up at really, really healthy levels. With all of this kind of distortion that's going to happen around trade flows and maybe scrap from the US being not allowed to go into China, it's really going to tighten things up. So, for us, when we run portfolios, really kind of where the alpha and kind of where we think we create the most performance is by kind of looking over the medium to longer term. It's it's harder to pick those very, very short term trends in commodity price moves. So when we look out on that medium to longer term view, we see some great value in some of the copper equities. But I think we have to also be, what's the right word here? I think we can't be ignorant to the fact that there's a lot of volatility in the short term. So I think you've got to focus on companies that are pretty well capitalized, they're still generating positive free cash flow, that can weather the storm as you go through some shorter term volatility in price when you want to take those longer term views.
Do you think that volatility is an opportunity for you? I mean, you've got 30% now in copper. Is it still an opportunity if you see those companies coming on with that long-term story?
Absolutely. I think one of the key things is that we've kept our overweight to copper as we've gone through the volatility. So there was some quite painful moves there, and we actually selectively added to some exposure post the sell-off. And the other thing that we also did is we stepped up our option writing to capture that volatility in the market and bank that through to income.
Okay. I wanted to talk just quickly about a couple of features of the trust that perhaps people aren't as aware of as maybe they would like to be. So let's start with the first, is that you have a sort of unquoted investment allocation within the portfolio. Could you just explain to listeners what that is and the benefits of it?
Yeah, so we have kind of two parts of unquoted. The first is, which is the area we've probably done most of through time, is exposure to royalties. Now, a royalty is, if you think about it, a musician gets a royalty when they write a song. Every time the song is played, they get a royalty check, and obviously that's pretty valuable to musicians as part of their overall income stream. We can also do royalties on people who invent pharmaceutical products, and so on. And a royalty on a mining asset is, a geologist might go and discover a new deposit of a mineral, and then somebody else might build the mine, and the geologist might sell that deposit that they've discovered, and they will get some cash from selling it. And then every time that a unit of the mineral, copper, gold, etc., is produced, they'll get a small payment, and that's effectively the royalty. So they're exposed to the amount that's produced, and obviously they're exposed to the price that mineral trades at. And typically you can get 1%, 2%, 3% royalties on mineral assets. So we have some royalty exposure as part of our unquoted element of the portfolio, principally to copper, gold, and iron ore. The three commodities that we're exposed to there. And then the other part of the unquoted is to companies that aren't yet listed on a public exchange. And so we have some small positions in companies that remain private, but with the anticipation that those companies will IPO or will have a liquidity event at some point in the future. There are two names there. One is a copper technology company, which has got exposure to cash flow today in terms of revenue today from the deployment of their technology, and we're hoping that one can continue to grow. Another is an early stage copper exploration business, which seems to be doing pretty well.
And just quickly, do those companies come on your radar via your network? How do you?
Yes. They do, yeah. So, I think we're in a very fortunate position, being that one of the largest investors in natural resources in the world. So, the flow of opportunities that we see is pretty broad. So it does allow us to kind of pick and choose these, but we have a very, very tough valuation framework that we use, and as a result, it's we would love to do more, but being disciplined about how we do this is designed really to reflect the risk that you get from being exposed to illiquid companies.
Okay.
It's also just on that, in terms of some of those private companies, we've actually had some great success over the last couple of years with two of those companies IPOing, both at sort of 100% higher than where our initial entry price was. So they have been a really good source of alpha, but once again, very selective in kind of the way where we invest here.
Okay. And then another element, obviously, that perhaps people don't immediately associate is that you have a dividend portion of the portfolio. Could you maybe just explain what that looks like as well?
Sure. Yeah. Dividends have been a very important part of the trust, and the main kind of reason for that is that mining companies, by their kind of what is the business of a mining company? Well, it's you find something, you develop it, you dig a hole in the ground, you produce the commodities, and if you don't pay a dividend, then where do shareholders get their return? And so dividends are a very important part of the total return that a mining company can give to its shareholders, and so for us, being an investor in a portfolio of mining companies, it's really important that we maximize the income potential, because then we're exposed to the largest part of what is the return that mining companies generate through time. And so we, in 2010, we sought to make sure that we sweated the portfolio as hard as possible to maximize the income potential while still being focused on the capital growth. And since then, we've had this very, very strong dividend track record. And this isn't a fixed dividend. We pay out everything. The language is that we pay out substantially all. This is the director's language of all of the income that's generated during the year. So there is income volatility. As companies pay us more or less, that is reflected through in our dividends. But what we have also tried to do is diversify our sources of income. So we aren't just beholden to the ordinary dividends that companies pay. We get income from being invested in fixed income securities. We get income from invested in the royalties that we have inside the portfolio that we just discussed. And we get income also from selling volatility, as Olivia mentioned earlier on, out of the market. So where this sector is inherently volatile, because we're always invested, we have a high degree of exposure to these names. So selling volatility to the market is a natural thing that we're able to monetize. And that, again, It's diversification plus incremental growth in terms of our dividend. And therefore, if you think about 2016, when most mining companies cut their dividends to zero, we were still able to pay a very, very healthy dividend. And so that what we're doing is trying to soften that journey through time in terms of dividend. And 2024 was another great example where mining companies cut their dividends and our dividend fell because we had less income coming in, but it exceeded expectations. We were able to pay out more than most people thought. And we hope we're going to be able to do the same in 2025 and going forward from there.
Okay, I wanted to touch on a couple of countries, but maybe perhaps not just necessarily in the tariff sort of sphere, but let's start with China. Obviously, it's had a really strong 6 months until recently, following a tough period. Just sort of how important is China in terms of the outlook for mined commodities? Are the two integrated? How big a sort of focus is your sort of macro overlook on sort of an area like China when it comes to your general outlook on commodities?
Yeah, so China is very key to the outlook for most commodities. Typically, in the commodities that we're investing in, they account for 50% or more of demand. So the direction of travel for China is something that we spend a lot of time looking at. And interesting, we've just had China's GDP for Q1 come out this morning, and it's running ahead of the 5% target for GDP growth for this year. So actual activity on the ground in China following the stimulus measures at the end of last year is, we are seeing a pickup, and it's quite interesting actually how China's demand is evolving. If you have a look back kind of 15 years ago, China's investment was very kind of property focused, early infrastructure in focus. Now, as you look at how their spend is evolving, it's very much going through to green infrastructure. A lot of investments into the battery material supply chain, EVs, wind, solar, advanced manufacturing. So as the economy develops, as the consumer becomes wealthier, their spending habits are changing. And that's really important for us to understand, because it kind of dictates what commodities we believe will benefit more than others. So we do spend a lot of time looking at this. And we do think that, China has got the kind of means and the firepower to keep on, growing the economy in time at a lower rate than in the past. But we continue to see, still quite, significant growth in areas like copper, like aluminium, even areas like steel as we go forward as well.
Okay. We've also seen a bit of a pickup in infrastructure spending in Germany and a sort of broader trend towards onshoring manufacturing in the US. Could you maybe just give us an insight into sort of how significant these developments are for demand across the mining sector?
Yeah, so I think this is quite an interesting theme that we expect to play out over a number of years. And part of it, I would say, is in response to some of this tariff action. But we are seeing now increasing spend on infrastructure and onshoring of manufacturing across a range of developed economies. More recently, we've obviously had announcements out of Europe, most notably out of Germany, where they're proposing to spend $500 billion on infrastructure. And that is a very significant number relative to where they have been in the past. So if we have a look back over the last decade, I'd say even almost 2 decades, some of these developed economies have not spent the appropriate amount of money on infrastructure, and their overall share of commodity demand has declined as China has accelerated. We think that we're going to see, a rebasing of some of this as we move forward, and efforts around tariffs and protectionism requires domestic spending again. So very much we see kind of like a rewiring, a rebasing of where commodity demand is going to by virtue of country, as opposed to being a heavily dominated China story like it's been for the last decade.
Okay. And sort of one other area I wanted to focus on was uranium, which sort of accounts for almost 4% of the portfolio, or it did. I'm not sure it still does. Should we expect nuclear energy to sort of play a greater role in the sort of energy transition from this point?
Yes, there's definitely been a renaissance in uranium and nuclear more broadly. And maybe for people who aren't as familiar with nuclear, it is the single source of zero emissions baseload power. So it does very much feel like it should fit within, the kind of the energy transition and the broader energy mix going forward. So we are seeing increased focus on nuclear. You're seeing a lot of the tech hyperscalers look to use nuclear to power their data centers that they intend to build over the next 5, 10, 15 years. And that will require over time increased investment into uranium. We've seen the uranium spot price, move up from sub $50 a pound 2 years ago to closer to $80 a pound now. And we're also just seeing a pickup in contracting activity and investments across the entire nuclear supply chain more broadly. So yes, we have a position. We've really just focused on a single producer here who is the only uranium producer who is fully integrated across the entire nuclear value chain. And it's an area that we're continuing to watch because I do think it'll be a source of growth for the future.
Just quickly, you mentioned the spot price there. Do you still think it's cheap versus history, or is it hard to gauge versus history now, given the story that you think it's starting to be involved in terms of the energy transition?
Yeah, I think it can be a little dangerous actually for a lot of commodities to always look at a current price versus history, because it's really important to focus on the margins for the producers, and there has been a lot of cost inflation and capital cost inflation across the space. As we look forward and we think about the amount of new uranium supply that will need to be added to the market and the cost of delivering those pounds into the market, you need a price around this level or higher to be able to incentivize a lot of that supply in. So, I wouldn't say it's at all expensive now.
I wanted to finish with M&A. We touched on it a bit earlier. It obviously is a big part of the market, but how sort of involved have you been in the past couple of years? And do you think the sort of story around M&A will continue? Do you expect it to grow in the next couple of years as well?
Yeah, I think we'll both make some comments on this. I think the first thing to say is that M&A has been a feature of this sector and every other sector for years, and so I don't think it's going to be any different. One thing that I think has been on our mind is that if we look at the kind of the M&A journey through time, there was a kind of a peak of deployment of capital and money towards M&A in the kind of China related cycle in the early 2000s, and then that ended in 2011, and we had this period of, I guess, austerity in terms of activity going through to kind of 2015, 2016, and then the sector really sought to kind of recapitalize, rebuild trust, and so on. And so there wasn't much for many years, but we have seen a pickup just recently. I think one thing we need to be conscious of is we just need to watch out for companies doing ill-disciplined capital allocation, and where deals make sense, obviously that's fine. But when it's companies looking just to buy other businesses just for the sake of getting bigger, or spending too much money on a transaction, so you're not going to get a return, that's what we're really keeping an eye on. And at the moment, we aren't seeing that happening. But there are signs that companies are looking to start overspending, whether that's internal growth projects or building internal growth projects, building assets, or looking to buy businesses. And if we were to see a deterioration in balance sheet strength, or companies not being as disciplined in deploying capital, then that would be an alarm sign for us. But I'll let Olivia comment on M&A last year.
Yeah, so we had a number of deals last year. Some of those are in the gold space. We also saw some action in the copper space as well. I think most notable was BHP's approach for Anglo American last year. When we kind of look at M&A, I think a really interesting thing to look at is, what is the cost of building new capacity versus buying that capacity through buying a company? And when we see some of the capital cost inflation and the rising capital intensity of building new copper projects, actually that kind of buy versus build argument becomes quite interesting to us. So, I think that is something that the corporates are constantly looking at. I think also when we look at M&A sort of going forward, projects and growth are becoming more challenging, and they're sort of more technically challenging. and actually having just the expertise within your company to be able to develop these projects becomes a bit tougher. So I think also, once again, combining with other companies to kind of develop projects also makes sense as well. And I think the other thing too, which is also quite interesting to think about, is companies that look at M&A for growth provide, obviously they need to be sensible in terms of the valuation that they're paying and the returns that they're targeting. But for every dollar that's spent on M&A, that's a dollar that's not spent on adding new supply. So it also tightens up those commodity markets as well. And I think the corporates are very aware of that too. So, the volatility that we've seen, always opportunities are thrown up, and I would think that M&A remains a part of the market this year as well.
Evie and Olivia, thank you very much for your time today. I have a whole load of more questions, but I appreciate that, we've only got so much time today, but I really appreciate you spending some of it with us.
Thanks so much, Chris. Yeah, thanks a lot.
BlackRock World Mining is a specialist trust offering exposure to mining and metals companies globally. It also offers an attractive dividend yield to investors. For more information on the BlackRock World Mining Trust, please visit fundcaliber.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.